everybody's got including yourself just there, everybody's got a foot out the door saying, when do I exit? Right. And so what we've had here, we're just beginning an easing cycle. If the Fed is truly just beginning to cut, and that there's going to be many, many cuts between now and the end of next year, where you could see the Fed fund rate go from, 4.25 here down to even zero. They don't know that yet. They have no idea that's what's coming. But if in the next 18 months, that's what you're looking at, and you're early on in that, and you're at a point where it doesn't look like the economy's falling out of bed, gold's got a ways to run. Silver's got a ways to run. The stock market's got a ways to run. And yet everybody's getting nervous here rather than bullish.
Perfect segue, actually, to discuss sort of how does it impact the consumer, right? Auto loans, mortgage rates, they're all tied to the longer end of the yield curve here, meaning the 20 and 30-year bonds. In regard to the rates, like, what do you think the expectations, or not the expectations, the outcome will be for those, for this market, for the housing market in particular? Is it such a huge factor?
Yeah, in the short run, meaning, if we get rates down, a few cuts here between now and the end of the year, and we get mortgage rates down under 6%, you could get a bounce in housing. Housing's declining. Housing's rolling over. That's part of the weakness I think we're seeing in the economy, and why I'm so sure the economy is going to continue to weaken. But you could get a bounce in housing and autos as rates come down, because, I don't think it's just a September cut. It's probably 3 cuts into the end of the year. And they could be, half-point cuts if things continue to deteriorate. So I think you could get a bounce in some of those things. And that's one of the reasons why we're not going to see the stock market fall out of bed, because I think there's countermeasures here that are going to it's going to allow the narrative to continue to be soft landing, no recession in sight, even though I think we could already be in recession when they go back and look at it. But so short term, you could get a bounce in housing and other interest rate sensitive areas like autos. But ultimately, the reason I'm so bullish on the bond market, so bearish on rates, saying rates are going to go down a lot, is because I think the economy is going to weaken a lot in 2026. So meaning, a very deep recession and ultimately a bust. So I don't think rates, as they're falling during that period, are going to help the consumer. The consumer is going to be in trouble. The job market's going to be deteriorating a lot. You could go to double-digit unemployment by the end of the bust. So, again, go back to 2008-9. That's kind of the script, except I think because of the leverage in the system, this time could actually be worse.
It could be, because everybody's levered. Debt is insane. Reaching how close are we to 38 trillion now? Getting closer by the day, obviously.
Well, and this is a global bust. So I use the number 330 trillion in global debt. 330 trillion. Wrap that around your brain. And quadrillions in notional value of derivatives. And derivatives are leverage on the markets, whereas debt is leverage on the system, on the economy. So you've got two forms of leverage there that are way beyond anything we've ever seen in history. We're in uncharted territory, and leverage is great. It enhances returns on the way up. It enhances the economy on the way up. The problem is when things turn south, basically leverage exacerbates the downturn in a big way. So that's the thesis, is I think people are underestimating, and including the Fed, underestimating the size of the risk out here. The magnitude of the risk, I think, is beyond anything we've ever experienced.
US dollar. We need to talk about the Dixie as well in relationship. It is holding in better than I would expect personally. We're trading around 97.5 on the Dixie. What are your expectations for the dollar? I know you've been calling for a bit lower dollar here in general. Like, are you surprised it's holding in as well as it is?
Not at all. I mean, the dollar's fallen from, basically 110 to 97 in a matter of a year, probably, or less. And I think it's my target is 82. That's far below here. it'll happen in some pretty steep steps. So the first step down in the mid 90s, and then you consolidated here. I think the next step down takes you down through 90, and then the third step down to 82. So I'm not surprised at all. You have to go through consolidations when you have such a big decline. It then goes the other way for a little while. You have to convince some of the people that were jumping on the bandwagon, but not with conviction, that whoops, this thing's going the other way. So I think we've just pretty much gone through that consolidation, and now we're beginning the next leg down, and I think it could happen pretty fast.
Yeah, it's the typical, like, was it the bear flag, not the bull flag, the bear flag, because we're seeing that stabilizing pattern.
Yep.
We've seen that in gold, which is a perfect segue, like I've planned it. We've seen it in gold, but to the upside, it was a bull flag. Now we're seeing that bear flag in the dollar. Is that a fair observation here, David?
Absolutely, and I do say gold was in a consolidation from basically April till recently, and it broke out, from 3,300, 3,400, broke out here, and we're at new highs again. I raised my target to 4,000 last year, or not last year, I think a couple letters ago. And I'm not going to be surprised if that proves to be low, more conservative. So I'm very bullish gold here. I'm even more bullish silver. Silver's had a great run. It's up. I just did the numbers yesterday. From April to now, gold is up 21%, I think, and silver's up 49%. So it's quietly, people haven't really noticed, but it's quietly outperforming gold as it does in a bull market. So I think silver has a long ways to go. Gold probably has a good ways to go too. So I think the weaker dollar is certainly part of that story. Lower interest rates is certainly part of that story. Global unrest and global uncertainty is certainly part of that story. And the central banks around the world gobbling up gold is certainly a piece of it too. So, and then the final piece, which people always underestimate, is the power of the momentum. It's all of a sudden the institutions are starting to notice gold, even though it's been running for years. Because it's got that momentum now, they're starting to say, hey, we have to have a piece of gold in our portfolios.
Yeah, even good friends of mine started reaching out, asking me about gold mining stocks now, which has me very nervous, quite honestly.
It's getting closer to a place where it'll, because I believe in the bust, most assets are going to go down other than treasuries. But so gold will correct. If 4,000 were the high, and it may not be, could just easily be 4,500, but if 4,000 is a high, you could be back to 3,000 or below in the bust. People want a target in the bust. I go, we don't even know what the high is on the way up. So, but it'll get hit by 30% or more probably. Silver, if my target on silver is 75, if we correct from 75, that is more volatile, so that could go down, back into the below 30 or back into the 20s. So they're not going to be straight lines. In both cases, I think this is important. In both cases, in the post-bust era, which is 2027 and beyond, I believe you'll see gold probably in the early 2030s and silver same time frame. Gold to 20,000 and silver to 500. So that's why it's important to understand that in the bust, you can have a sizable correction. So you may not want to be a buy and holder and just say, I'm going to ride through it. Because if you lose 30 to 70% of your money in the bust, you may not want to hold, you may get nervous and get out at the bottom. So it's better to get out when it's moving up. On the other hand, there is a much, much bigger upside to this post-bust.
What is priced in? Maybe last question on gold here. What is currently priced in? Because I'm a little nervous looking at it. Is it 2 rate cuts, 3 rate cuts like the market predicts by year end? What is priced into gold right now? And are we going to have a sell the news day on next Wednesday here? Is that something you look at as well?
Well, think about that. I think that tells you the sentiment that's on the street. Everybody's got including yourself just there, everybody's got a foot out the door saying, when do I exit? Right? And so what we've had here we're just beginning an easing cycle. If the Fed is truly just beginning to cut, and that there's going to be many, many cuts between now and the end of next year, where you could see the Fed fund rate go from 4.25 here down to even zero. They don't know that yet. They have no idea that's what's coming. But if in the next 18 months that's what you're looking at, and you're early on in that, and you're at a point where it doesn't look like the economy's falling out of bed, gold's got a ways to run. Silver's got a ways to run. The stock market's got a ways to run. And yet everybody's getting nervous here rather than bullish.
No, that's we've seen that in April, of course, and last year in August as well. Everybody was nervous. Volatility was high, but volatility doesn't exist right now. And I should be putting a bow around their conversation right now, but volatility is dead. If volatility was a heartbeat, the VIX, it'd be flatlining right now. It's at 15, zero volatility, pretty much.
I said probably 3 or 4 years ago, because I was calling for this melt up, and I get accused of raising my targets constantly. I go, that's what you do. As the evidence proves it's got more, there's more things saying it should go higher, you raise your target. So, I started out at 6,000, or even before that at 4,000, but I've raised it to, 7,000 and 7,500 and 8,000, now 8,700 on the S&P. And same thing, I've raised my gold target a few times. But it's the case that this thing is a big historic bull market, and you just gotta stay with it. I'm sorry, I lost my train of thought of what you would. Oh, you were talking about the VIX. Several years ago, I said the VIX could go to 10, and that was when it was in the 20s. And I said if we've got, and that was when I thought the market might go to 4,800, 5,000. I still would say that the low on the VIX, I think, is down just below 10. I think that's probably where we're headed again. So everybody gets worried when it gets down at 14, 15. I go, it can keep going, and there's no magic at 10. If it wants to go lower, it's really, it's a trading vehicle. There are times when it the market goes through a swoon, and it bounces back up over 30 and maybe over 50. But other than that, I don't use it at all to say this is the top in the market, because it can go lower.